Welcome to this comprehensive summary of Common Stocks and Uncommon Profits by Philip A. Fisher, one of the most influential investment books ever written. First published in 1958, this book became the first investment title to make the New York Times bestseller list. Fisher's philosophy influenced legendary investors like Warren Buffett and shaped modern growth stock investing. Philip Fisher managed investments for over 7 decades, developing a unique approach focused on finding exceptional companies and holding them for the long term. His son Ken Fisher, in the book's introduction, notes that his father's methodology emphasized quality over quantity, often holding fewer than 10 stocks at a time. This summary will explore Fisher's complete investment philosophy, including his famous 15 points for evaluating stocks, his approach to buying and selling, and the timeless wisdom that made fortunes for those who followed his advice. We'll also examine real-world examples from Fisher's career that illustrate these principles in action. Part 1. The Fisher Philosophy Fundamentals. Looking back to move forward. Fisher begins by examining investment history to understand what creates wealth. He observed that the greatest fortunes came not from trading in and out of stocks based on market timing, but from identifying outstanding companies and holding them through market fluctuations. Consider this remarkable fact. Between 1925 and 1950, scores of companies existed where a $10,000 investment would have grown to $250,000 or more. These opportunities didn't require perfect timing at market bottoms. The shares were available year after year at prices that would eventually produce spectacular returns. The key was identifying companies with exceptional characteristics and having the patience to hold them. Fisher argues that opportunities in his era, and by extension in any era, are actually better than in the past. Why? 3 major developments. First, modern corporate management emerged, with professional teams replacing family-dominated businesses. Second, research and development became systematized, creating continuous innovation. Third, government policy shifted to prevent severe depressions through deficit spending and economic intervention. These changes meant that outstanding companies could sustain growth longer and with less cyclical interruption than ever before. The investor's challenge wasn't finding opportunities, it was developing the skill to recognize them. The scuttlebutt method. One of Fisher's most distinctive contributions is what he called the scuttlebutt method, gathering information through a network of informed sources rather than relying solely on financial statements. The business grapevine, Fisher discovered, is remarkably accurate. Visit 5 companies in an industry, ask intelligent questions about competitors, and a detailed picture emerges. But competitors aren't the only source. Customers can tell you about product quality and service. Suppliers reveal information about financial stability and growth. Research scientists in universities and government know about technological capabilities. Trade association executives understand industry dynamics. The key is building trust. Sources must know their information will never be attributed to them. Fisher emphasizes that this isn't about seeking insider information for trading advantage. It's about understanding business fundamentals that numbers alone cannot reveal. Former employees can be particularly valuable but require careful handling. Some may have legitimate grievances. Others may have been justifiably terminated. Cross-checking their information against other sources is essential. This method takes time and effort, which is precisely why it works. Most investors won't do this work, creating opportunities for those who will. Fisher notes that he could spend months investigating a single company, talking to dozens of people, before ever contacting management. Part 2. The 15 Points. Fisher developed 15 specific criteria for evaluating potential investments. These points address both current business quality and future growth potential. Let's examine each one. Point 1. Market potential. Does the company have products or services with sufficient market potential to enable a sizable increase in sales for at least several years? This is about more than current success. It's about runway for future growth. Fisher distinguishes between companies that are fortunate and able versus fortunate because they are able. Aluminum Company of America exemplified the first category. Management was good, but the company benefited enormously from external factors like the development of air transportation that it didn't create. DuPont represented the second category. Through brilliant research and business judgment, the company created its own opportunities, moving from explosives into chemicals, plastics, and fibers. The investor must assess not just the industry's prospects but the company's specific position within it. A rising tide lifts all boats, but some boats are better positioned to rise higher and faster. Point 2. Management's determination to develop new products. Does management have a determination to continue developing products or processes that will further increase total sales potential when growth from current lines has largely been exploited? This separates one-trick ponies from sustainable growth companies. Companies can grow for a few years on one successful product, but true investment opportunities come from organizations committed to continuous innovation. This requires both a philosophical commitment to growth and the practical ability to execute research and development effectively. Point 3. Research and development effectiveness. How effective are the company's research and development efforts in relation to its size? Here Fisher warns against simplistic analysis. Many investors compare R&D spending as a percentage of sales, but this can be misleading. Companies vary enormously in what they classify as R&D. More importantly, the quality and productivity of research varies dramatically. Fisher identifies several factors that determine R&D effectiveness. First, the ability to coordinate experts from different disciplines into effective teams. Modern innovation rarely comes from lone geniuses but from teams of specialists working together. Second, coordination between research, production, and sales. The best research designs products that can be manufactured efficiently and sold effectively. Without this coordination, companies develop technically brilliant products that fail commercially. Third, top management's understanding of the research process. Development projects cannot be expanded in good years and curtailed in bad ones without tremendously increasing costs. Crash programs that pull researchers off long-term projects for short-term goals waste resources and demoralize teams. Fourth, the evaluation of government-sponsored research. Defense contracts can be valuable, but their worth varies enormously. The best defense work teaches techniques applicable to commercial products, essentially providing free R&D at government expense. Point 4. Superior sales organization. Does the company have an above-average sales organization? Products don't sell themselves. Even with the best mousetrap, customers must be made aware of its advantages in terms they understand. Fisher notes that while investors heavily analyze production costs and research capabilities, they often ignore sales effectiveness. Yet a powerful engine with a loose belt delivers only a fraction of its potential, just like a great product poorly marketed. Sales effectiveness can't be captured in simple formulas, which is why many investors overlook it. But through scuttlebutt, it's often easy to evaluate. Customers and competitors know which companies have strong sales organizations. Companies like Dow Chemical invest as heavily in training salespeople as in training research chemists. IBM's salespeople spend a third of their time in company-sponsored training. This isn't overhead, it's investment in competitive advantage. Point 5. Worthwhile profit margin. Does the company have a worthwhile profit margin? Profit margin, the number of cents from each sales dollar brought down to operating profit, is critical for two reasons. First, it provides a cushion. In difficult times, high-cost competitors face devastating losses while low-cost producers remain profitable. As weak competitors exit, the low-cost producer gains market share and pricing power. Second, it funds growth internally, avoiding the dilution of equity offerings or the burden of excessive debt. Fisher warns against investing in marginal companies with thin margins unless fundamental changes are underway to improve them. The best investments have among the highest margins in their industries. There's one exception: young companies deliberately spending heavily on growth. If a company is sacrificing current profits to finance additional research or market development that will fuel future growth, temporarily low margins may be acceptable, but only if you're certain that's genuinely what's happening, not just excuses for poor performance. Point 6. Maintaining or improving profit margins. What is the company doing to maintain or improve profit margins? In a world of rising costs, profit margins naturally erode unless companies actively work to maintain them. Some companies protect margins simply by raising prices when costs rise. But this attracts competition. The sustainable approach is improving efficiency through better technology, streamlined processes, and innovative cost reduction. Fisher gives the example of companies with capital improvement departments whose sole function is designing equipment to reduce costs. Others constantly review procedures seeking economies. Accounting systems and transportation methods are particularly fertile areas for cost reduction. The investor should investigate the ingenuity being applied to cost reduction. Companies making genuine progress here are positioning themselves for sustained profitability. Point 7. Outstanding labor relations. Does the company have outstanding labor and personnel relations? Poor labor relations create obvious costs through strikes, but the hidden costs of mediocre relations are even greater. When workers feel fairly treated, they become more productive. Low turnover reduces training costs. A positive environment attracts better employees and enables effective leadership. How to judge labor relations. Several indicators. In highly unionized areas, companies that remain non-union probably have excellent relations. Unions would have organized them otherwise. However, unionization itself isn't necessarily negative. Many companies with unions maintain respectful, constructive relationships. Watch for other signs: relative labor turnover compared to competitors, the length of job applicant waiting lists, how quickly grievances are resolved, and whether wages are above average for the area. Companies paying below market wages while generating high profits are storing up trouble. Most revealing is top management's attitude toward ordinary workers. Do they view employees as costs to be minimized or as assets to be developed? The answer profoundly affects corporate culture and long-term success. Point 8. Outstanding executive relations. Does the company have outstanding executive relations? If good relations with workers matter, excellent relations with executives are vital. These are the people whose judgment and teamwork determine success. Key indicators. Is promotion based on ability or factionalism? Do executives have confidence in top leadership? Are salaries competitive? Does management bring in outsiders only when absolutely necessary, or do they regularly hire externally for senior positions? A strong executive climate means people throughout the organization believe advancement is based on merit, feel their compensation is fair, and trust that the company will invest in their development. This atmosphere doesn't happen accidentally. It requires conscious effort from top management. Point 9. Management depth. Does the company have depth in management? A small company can succeed under brilliant one-person management, but sustainable growth requires developing executive talent throughout the organization. The critical question: could the company continue succeeding if key individuals were suddenly unavailable? For young companies, this is less critical because they often become acquisition targets for larger firms with management depth. But as companies grow, they must develop executive talent. Management depth requires more than good people. It requires proper delegation of authority. If top executives try to handle routine operational details themselves, two problems emerge. They become overwhelmed, and talented people below them never develop their capabilities because they lack real authority. Fisher warns about executives who won't delegate. The organization may function while it's small, but it hits a ceiling when size demands distributed decision-making. Point 10. Cost analysis and accounting controls. How good are the company's cost analysis and accounting controls? Without accurate, detailed cost information, management operates blind. Companies need to know not just overall costs but the cost of each step in operations. Which products are genuinely profitable? Which are actually losing money despite appearing successful? Where are specific inefficiencies? Fisher acknowledges this is difficult for outside investors to evaluate. The scuttlebutt method sometimes reveals serious deficiencies, but determining whether accounting controls are truly excellent requires deeper access. Generally, companies excellent in other areas also excel here, if top management understands the importance of expert accounting controls. Point 11. Industry-specific advantages. Are there other aspects of the business, peculiar to its industry, that will give important clues about how outstanding the company is relative to competition? This catch-all point acknowledges that different industries have different critical success factors. For retailers, real estate expertise, the quality of leases and store locations, can be crucial. For some businesses, credit management is critical. For others, it barely matters. For companies where insurance is a significant cost, superior insurance management indicates overall operational excellence, since lower insurance costs reflect better handling of people, inventory, and property. Patent positions vary in importance by industry and company size. For small, young companies, strong patents can be essential protection while building production, sales, and customer relationships. For large companies, patents usually provide supplementary rather than fundamental strength, blocking certain competitive approaches but rarely preventing all competition. The investor must understand which factors truly matter in each industry and assess the company's capabilities in those specific areas. Point 12. Short-range or long-range profit outlook. Does the company have a short-range or long-range outlook regarding profits? Some companies maximize immediate profits. Others strategically limit current profits to build long-term value. Consider how companies treat customers and suppliers. One company ruthlessly pursues the sharpest possible deals with suppliers. Another occasionally pays above contract price to ensure reliable sources during shortages. One company maximizes profit on each transaction. Another rushes a critical order to a customer at reduced profit to build loyalty. The company with a genuine long-range outlook may show lower current profits but generates far greater profits over years. The investor should favor companies with authentic long-term vision, not just lip service. However, be sure management is actually building long-range value rather than merely claiming to while underperforming. Point 13. Future equity financing needs. In the foreseeable future, will growth require sufficient equity financing so that the larger number of shares outstanding will largely cancel existing stockholders' benefits from anticipated growth? This is Fisher's most mathematically oriented point. If a company needs to issue large amounts of new stock to finance growth, existing shareholders' ownership gets diluted. The resulting larger number of shares can offset the benefits of growth. However, Fisher argues this concern is overstated for truly outstanding companies. Companies that score well on the other 14 points can usually borrow funds or generate sufficient internal cash flow to avoid excessive dilution. If a company qualifies as outstanding in all other respects, it can secure capital on reasonable terms. The key is evaluating whether the company's fundamentals are strong enough to minimize dilution risk. If so, don't avoid an otherwise excellent investment because of concerns about future financing. Point 14. Management candor. Does management talk freely to investors about its affairs when things go well but clam up when troubles occur? All companies experience setbacks, unexpected difficulties, profit squeezes, unfavorable market shifts, and failed product developments. How management handles adversity reveals character. Do they maintain open communication, or do they go silent when reporting bad news? Companies that clam up may lack plans to address problems, may be panicking, or may not feel accountable to shareholders. Fisher emphasizes that honest, forthright communication during difficulties is actually a sign of strength. The investor should avoid any company that withholds or tries to hide bad news. Temporary setbacks are inevitable and manageable. Dishonesty about them is neither. Point 15. Unquestionable integrity. Does the company have management of unquestionable integrity? This is Fisher's ultimate point, and his position is absolute. Without integrity, nothing else matters. Management is always closer to company assets than shareholders. Without genuine trusteeship, countless ways exist for insiders to benefit at shareholders' expense. Excessive salaries for themselves and relatives, selling or leasing property to the company at above market rates, directing brokerage commissions to firms they own, granting themselves excessive stock options. The scuttlebutt method is particularly valuable for assessing integrity. Talk to enough people in and around a company, and patterns of behavior become clear. Fisher's rule is uncompromising. An investment may be considered despite weakness in almost any other of the 15 points if it rates unusually high on the rest. But if there's serious question about management integrity, the investor should never participate, regardless of how attractive other aspects appear. Part 3. When to buy and sell. The timing of purchase. When should you buy stocks that meet Fisher's 15 criteria? His answer challenges conventional wisdom about market timing. Most investors believe in studying economic data, forecasting business cycles, and timing purchases accordingly. Fisher considers this approach futile. Economic forecasting, he argues, is about as far advanced as chemistry during the Middle Ages. Basic principles are emerging, but they cannot yet be safely used as a basis for action. Consider the track record. Even leading economic authorities regularly disagree, and forecasts that seem compelling often prove spectacularly wrong. Fisher conducted an experiment. He reviewed old issues of the Commercial and Financial Chronicle, examining economic forecasts from various years. The disagreements among experts were remarkable, and some of the most convincing arguments turned out completely wrong. Instead of trying to time the market, Fisher recommends timing individual stock purchases based on company-specific developments. The key is buying when the financial community's appraisal of a company is significantly less favorable than fundamentals warrant. Company-specific timing opportunities. Several situations create buying opportunities. First, commercial plant startups. When a company is about to start its first full-scale plant for a promising new product, troubles are almost certain. Even established processes require 6 to 8 weeks of expensive shakedown. Revolutionary new processes may take far longer. As delays mount and costs accumulate, the stock often drops dramatically, even though these difficulties are temporary and predictable. Fisher gives the example of American cyanamide in the 1950s. A major new plant at Fortier, Louisiana, lagged far behind schedule. As problems continued, the stock price fell to levels that proved, in hindsight, absurdly low. Those who recognized that startup difficulties were temporary made fortunes when the plant eventually reached profitability and the company's other strengths became apparent. Product development challenges. Companies introducing new products often face unexpected difficulties. If the company's fundamental strengths remain intact, these temporary setbacks create buying opportunities. Fisher cites his own experience with Motorola in the 1950s. The stock fluctuated weekly for over a year, with one major client refusing to call it by name, referring to it only as that turkey. Yet as the communications division's value became apparent and semiconductor operations turned around, the stock became a spectacular performer. Organizational changes. Sometimes companies must restructure as they grow, creating temporary inefficiency. If the changes position the company for better future performance, Near-term profit impacts create buying opportunities. When not to buy. Fisher is equally clear about when not to buy. Don't buy promotional companies. Companies in the startup phase are too risky for most investors. Even with brilliant ideas, startups face enormous challenges that are impossible to evaluate accurately from the outside. The batting average for selecting successful startups is far lower than for choosing among established companies. Leave startup financing to specialized venture capitalists who can provide management support and have the expertise to evaluate early-stage businesses. Don't ignore over-the-counter stocks. The over-the-counter market often offers excellent opportunities. Many investors mistakenly believe only listed stocks provide adequate liquidity, but this reflects outdated thinking. Well-managed, regularly traded OTC stocks often have better marketability than many exchange-listed stocks, particularly those on smaller exchanges. Don't be influenced by annual report tone. Annual reports are designed to build goodwill. They're sales tools, inevitably presenting the company's best foot forward. They rarely provide balanced discussions of real problems. While annual reports should be read, they shouldn't drive investment decisions. Judge companies by facts obtained through thorough investigation, not by polished presentation. Selling decisions. Fisher believes selling should be rare if purchases are made correctly. He identifies only 3 valid reasons to sell. Reason 1. You were wrong. When the facts prove your initial purchase decision was mistaken, sell quickly. The key is recognizing errors promptly and learning from them. The most dangerous reaction is refusing to sell because you don't want to admit a mistake. Many investors hold on to losers hoping to, at least break even, missing opportunities to redeploy capital profitably. Reason 2. Deterioration. Sell when a company no longer qualifies under the 15 points. This usually happens in 2 ways. Management deteriorates through complacency, succession problems, or loss of talented executives, or the company's market opportunities are exhausted. Management deterioration is particularly insidious because it often occurs gradually. Success breeds complacency. The drive and innovation that built the company fade. Or new executives lack their predecessors' capabilities. The company may coast on past accomplishments while its competitive position erodes. Market exhaustion occurs when growth opportunities in current lines are largely exploited and the company lacks prospects for new product development. This doesn't necessarily mean the company is failing. It may be healthy but no longer offers unusual investment potential. Reason 3. Better opportunity. Occasionally, an investor finds an opportunity so much more attractive that switching makes sense even after capital gains taxes. This should be rare. Fisher emphasizes that switching requires great care. You must be very confident about both the sale and the purchase. When not to sell. Fisher is adamant about several circumstances that should not trigger selling. Don't sell on market forecasts. Many investors sell good stocks because they believe a market decline is coming. Fisher considers this futile. General market movements are extremely difficult to predict, while a specific company's prospects are much more knowable. Why act on uncertain market forecasts when you have high confidence in the company's future? History supports Fisher's view. Every major market decline has been followed by recovery to new highs. Outstanding companies have consistently emerged from bear markets at prices far above pre-decline levels. Selling to avoid bear markets means you must correctly predict both the decline and the recovery, and most investors fail at both. Don't sell because of high price-earnings ratio. Many investors sell when a stock's price-earnings ratio seems high relative to history or to other stocks. Fisher argues this often reflects narrow thinking. What matters isn't the price-earnings ratio relative to past years or current competitors. It's the ratio relative to future earnings. If a company will double earnings over the next 5 years while maintaining its competitive advantages, its current high price-earnings ratio may be quite reasonable. Fisher illustrates with a hypothetical. Two companies each sell at 20 times earnings, while companies with no growth prospects sell at 10 times earnings. Both double earnings over 4 years. Company A maintains strong growth prospects and continues selling at 20 times the new, higher earnings. The stock doubles. Company B's growth prospects disappear. It now sells at 10 times earnings. The stock is unchanged despite doubled earnings. The lesson: price-earnings ratios reflect expectations about future growth. If growth continues, high ratios can be sustained or even increase. Don't sell just because of large gains. One of Fisher's most counterintuitive teachings is that large gains should not trigger selling. If a stock has risen dramatically but the company's long-term prospects remain strong, hold on. This requires psychological discipline. When you've doubled or tripled your money, the temptation to take profits is nearly irresistible. But Fisher points out that the truly spectacular gains, 10 times, 20 times, even 100 times initial investment, come from holding companies through multiple doubling cycles. He cites his own experience with Food Machinery Corporation and other investments. In several cases, clients or potential clients were so focused on the large gain already achieved that they sold prematurely, missing subsequent gains several times larger than those they had captured. The 3-year rule. Fisher implemented a discipline to prevent holding failing investments too long. He calls it the 3-year rule. When he purchases a stock, he gives it 3 years to show worthwhile results. If after 3 years the stock hasn't performed, he sells, assuming nothing has changed his view of the company's fundamentals. This rule serves two purposes. It forces periodic reassessment of investment thesis, and it prevents indefinite holding of investments based on hope rather than evidence. Importantly, Fisher evaluates performance not over 1 year but over 3. Any stock can lag for a year due to temporary factors. 3 years provides enough time for real quality to emerge. Fisher violated this rule only once in his career, with Rogers Corporation, where his confidence in management and his understanding of temporary difficulties led him to hold longer. The company eventually vindicated his patience, but he acknowledges this was truly an exception. Part 4. Dividends and Diversification. The dividend question. Fisher's views on dividends evolved over decades and run counter to conventional wisdom. Most investors view dividends as unambiguously good, a bird in the hand. Fisher questions this assumption. For companies with strong investment opportunities, paying dividends rather than reinvesting earnings in growth actually harms long-term shareholders. Consider the mathematics. A company paying a 40% dividend might be taxed at a 20% rate on those dividends. Fisher's example used historical rates, but the principle holds. After taxes, only 80% of the dividend remains for reinvestment. Meanwhile, the company could have reinvested those funds tax-free, using 100% of the earnings rather than 80%. Over time, this difference compounds dramatically. A company that retains and wisely reinvests earnings can grow much faster than one paying those earnings out as dividends that shareholders must then reinvest after taxes and brokerage commissions. Fisher distinguishes between different types of investors. Investors needing income. Some investors, particularly retirees, need dividend income to support living expenses. For them, dividend-paying stocks make sense. However, Fisher wasn't serving this clientele. Investors accumulating wealth. For investors who don't need current income and are regularly saving anyway, low or no dividends are actually preferable. Why pay taxes on dividends? They'll just reinvest when the company can reinvest those funds tax-free. This logic led Fisher to focus almost exclusively on companies with low dividend payouts. Companies with such strong opportunities for productive investment that paying significant dividends would waste capital. The institutional complication. Fisher notes that institutional investors complicated this picture in recent decades. Pension funds and certain other institutions pay no taxes on dividends, eliminating the tax disadvantage of dividend payments for them. Moreover, Many institutions have policies requiring some dividend payment before they'll invest. This institutional demand has pressured even growth companies to pay modest dividends, despite the tax inefficiency for individual investors. Fisher accepts this reality but still believes the best opportunities generally lie among companies with low payouts or no dividends. Dividend policy matters. Fisher emphasizes that while the amount of dividends matters less than most think, the consistency of dividend policy is crucial. Investors need to plan their financial affairs, which requires knowing what to expect. The best companies establish a clear dividend policy and stick to it. They might pay no dividend while growth opportunities are abundant, then initiate a dividend as the company matures. Or they might pay a modest, stable dividend while reinvesting most earnings. What matters is consistency. Investors can plan around predictable policies but are confused and disturbed by frequent policy changes. Companies that constantly adjust dividends, paying extras when business is good and cutting in difficult times, create uncertainty that depresses stock prices. The market values predictability. Diversification, the opposite of concentration. Fisher's views on diversification are perhaps his most controversial. While conventional wisdom advocates wide diversification, Fisher argues the opposite. Concentrate in a few outstanding companies. His reasoning: truly outstanding companies are rare. If you found them through careful analysis, why dilute your portfolio with inferior holdings? Wide diversification often reflects either insufficient knowledge or lack of conviction. Fisher uses a vivid comparison: stacking rifles for stability. 2 rifles can't form a stable stack. 5 or 6 can. But adding more rifles beyond this point doesn't increase stability. The same applies to investments. Beyond a certain modest number, additional holdings don't reduce risk but do dilute returns. Fisher's diversification guidelines. Fisher suggests guidelines that shock many financial professionals. For individuals, 10 to 12 stocks is usually optimal. More than 20 is a sign of financial incompetence. The investor who owns 20, 30, or 40 stocks cannot possibly maintain adequate knowledge of all these companies. Either they're not doing proper research or they're spreading themselves too thin. For institutions, somewhat broader diversification may be needed, but not as much as commonly practiced. Fisher sarcastically notes that ERISA, the law governing pension funds, stands for emasculated results, insufficient sophisticated action, because it encourages excessive diversification that dilutes returns. Defining adequate diversification. What does adequate diversification mean? Fisher breaks it down. Large, established growth companies. If investing only in large, proven companies with strong positions, companies like Dow Chemical, DuPont, IBM in his examples, 5 holdings might suffice. No more than 20% in any single company initially. Medium-sized companies. For companies in the middle range, established but smaller, 10 holdings might be appropriate, with 8 to 10% in each. Small, young companies. These require more diversification due to higher risk. However, Fisher warns that most investors shouldn't invest in this category at all. Industry diversification. Don't have 8 bank stocks and call it diversification. Different companies should be in different industries with different economic characteristics. The best way to diversify. Fisher offers unconventional advice. Rather than holding mediocre companies for diversification, concentrate more heavily in the best companies. If you own 10 stocks and discover a much better opportunity, sell the weakest holding and add to your best prospects. This requires courage and conviction. Most investors feel safer with modest positions in many companies. But Fisher argues that this safety is illusory. You're diluting exposure to your best ideas while maintaining exposure to your weakest. Part 5. The Don'ts. Common mistakes. Fisher devotes significant attention to common investor mistakes. Here are his key don'ts. Don't buy promotional companies. As discussed earlier, Fisher is adamant. No matter how appealing a company in the promotional or startup stage appears, individual investors should avoid it. The batting average for successful selection is too low, and the investors lack ability to provide the management guidance these companies need. Don't ignore good stocks because they're over-the-counter. Many investors automatically reject over-the-counter stocks, believing only exchange-listed shares provide adequate liquidity. This is outdated thinking. Well-run OTC companies with active dealer interest often have better marketability than stocks on smaller exchanges. The OTC market works differently. Dealers maintain inventory and commit capital to make markets, whereas exchanges simply match buyers and sellers. For moderately active stocks, the OTC system can provide excellent liquidity. Don't buy because you like the annual report. Annual reports are public relations documents. They're designed to make the company look good, not to provide balanced analysis. Pretty pictures and nice words don't indicate good investments. Some companies with terrible prospects publish beautiful annual reports. Some outstanding companies produce plain, matter-of-fact reports. Judge companies by facts obtained through research, not by marketing materials. Conversely, don't be put off by plain or uninformative annual reports. If the underlying business is sound, as determined through your own investigation, the report's quality is irrelevant. Don't assume high price-earnings ratios mean overpricing. This point deserves emphasis because it's so counterintuitive. Fisher provides a detailed example. Imagine company XYZ, which has justified a price-earnings ratio of 20 for many years due to outstanding management and growth prospects. Currently, earnings are $1 per share and the stock sells at $20. Many investors conclude the stock is expensive compared to stocks selling at 10 times earnings. But suppose XYZ will double earnings over the next 5 years due to internal growth and excellent execution. If the company maintains its justified 20 times earnings ratio because it continues to offer exceptional prospects, the stock will double to $40 over that period. Meanwhile, an inexpensive stock at 10 times earnings might remain stagnant if the business has no growth prospects. After 5 years, even if earnings hold steady, it might still sell at $10. Fisher's point: the absolute price-earnings ratio means nothing. What matters is the ratio relative to future growth prospects. A high ratio for a truly outstanding growth company may be quite reasonable. Don't follow the crowd. One of Fisher's most important principles: doing what everyone else is doing usually produces average results at best. The huge profits come from recognizing value before the crowd does. This requires courage. When you're buying a stock that everyone else considers risky, or speculative, or troubled, you feel uncertain. When you're holding a stock that has risen dramatically while others insist it's too high and urge you to sell, the pressure is intense. Fisher quotes Shakespeare: "There is a tide in the affairs of men which, taken at the flood, leads on to fortune." The investor must learn to recognize when the tide is right, even if the crowd sees only danger. Don't forget Gilbert and Sullivan. Fisher uses the comic opera, The Flowers That Bloom in the Spring, to make a point. Some things have nothing to do with the case. 2 things investors obsess over that actually matter very little. Past price ranges. What a stock sold for 4 years ago tells you almost nothing about its current value. The company may have developed new products, improved operations, or encountered difficulties. Its fundamental worth may be completely different. Yet investors constantly make decisions based on whether a stock is high or low relative to its past trading range. This mental trap is powerful. When a stock has traded between $38 and $43 for a long period, investors come to see this range as the stock's true value. If it falls to $24, they rush to buy, assuming it's cheap. If it rises to $60, they rush to sell, assuming it's expensive. But if fundamentals have genuinely deteriorated, $24 might be expensive. If fundamentals have improved dramatically, $60 might be cheap. Past earnings patterns. Similarly, past earnings have limited relevance. 5 years of stable earnings don't guarantee future stability. A history of growth doesn't guarantee continued growth. The past provides context, but it's the future that determines investment value. What matters is current fundamentals relative to current price, and future prospects relative to what the market expects. Don't quibble over eighths and quarters. Fisher tells of a friend who refused to pay $34.50 for a stock, insisting on $34.25. The stock never declined to his bid and rose to several times the price he refused to pay. He saved a quarter and missed a fortune. For long-term investors in truly outstanding companies, small price differences are irrelevant. If you found a stock that will rise 400% over 5 years, does it matter whether you paid $34.25 or $34.75? Fisher admits to battling this tendency himself. It's psychologically difficult to pay a little more when you feel you can save money by waiting. But the math is clear. Missing an investment that rises several 100% costs far more than paying slightly more on initial purchase. Don't buy just because of short-term statistics. Fisher warns against buying stocks based on low price-earnings ratios, high dividend yields, or attractive statistical measures without understanding business fundamentals. These statistics may indicate value, or they may indicate problems. A low price-earnings ratio might mean the company faces serious challenges that numbers don't reveal. A high dividend yield might indicate a troubled company maintaining its dividend unsustainably to support the stock price. Statistics are starting points for investigation, not investment decisions themselves. Part 6. Finding growth stocks. Fisher provides detailed methodology for finding investment opportunities. The how-to of his approach. The 2 critical stages. Fisher identifies 2 stages in successful investing, both crucial. Stage 1. Deciding which companies to investigate thoroughly. This initial screening determines whether you'll even discover the real opportunities. Poor screening means wasting time on mediocre companies or missing outstanding ones. Stage 2. Making the final purchase decision after thorough investigation. This is where most investors focus attention, but it's useless without proper screening in Stage 1. Stage 1. Initial leads. Where should you look for investment ideas? Fisher tested various sources. Business executives and scientists. Fisher initially believed his best leads came from business people and scientists he knew. However, when he analyzed his results, he found this group provided only about 1/5 of his leads and only about 1/6 of his successful investments. Investment professionals. Fisher discovered that about 4/5 of his best ideas came from a small network of outstanding investment professionals scattered across the country. In New York, Boston, Philadelphia, Buffalo, Chicago, San Francisco, Los Angeles, and San Diego. These weren't just any investment people, but individuals Fisher had observed making consistently good stock selections over time. Why did this work so well? These professionals had already done preliminary screening. They understood what Fisher was looking for. While Fisher might disagree with their conclusions about specific stocks, the companies they suggested were at least worth investigating. Printed material. Fisher found little value in typical brokerage reports or financial publications for generating new ideas. These sources typically repeat what's already widely known. However, specialized trade publications occasionally provided useful background information. Research consultants. Major consulting labs like Arthur D. Little, Stanford Research Institute, or Battelle have excellent knowledge of technical developments, but their professional ethics prevent them from discussing most client work. Fisher found limited practical value here despite the theoretical potential. Stage 1 screening questions. Before committing to full investigation, Fisher asks preliminary questions. Is the company in lines of business offering unusual growth opportunities? Is entry into these fields relatively easy for competitors, or are there barriers protecting the leader? Based on preliminary information, does the company appear to qualify well on several of the 15 points? If answers are negative or unclear, Fisher moves on. With thousands of potential investments, there's no reason to spend time on mediocre prospects. Stage 2. Deep investigation. Once a company passes preliminary screening, Fisher begins intensive research, but notably, he doesn't start by contacting management. Initial document review. Fisher reviews SEC filings, focusing on specific items. Breakdown of sales by product line, competition, officer ownership, earnings statement details showing depreciation, profit margins, and research activity. He schemes the balance sheet for general capital structure, but doesn't perform detailed financial analysis at this stage. Scuttlebutt phase. Now comes the heart of Fisher's method. He systematically contacts key customers, suppliers, competitors, former employees, carefully evaluated, scientists in related fields, trade association executives, anyone else with relevant knowledge. Fisher emphasizes that he tries to see or reach every accessible person in these categories. If he doesn't know them personally, he seeks introductions through mutual friends or through the company's commercial bank. This phase can take weeks or months. Fisher is gathering detailed information about product quality and competitiveness, management capabilities and integrity, research effectiveness, sales organization strength, financial controls, labor relations, every other aspect of the 15 points. The 50% rule. Fisher has a critical discipline. Never contact management until Scuttlebutt has provided at least 50% of needed information. Why? First, without substantial background knowledge, you don't know what questions to ask. You'll waste management's time and your own. Second, management access depends heavily on your apparent competence. Companies with attractive prospects receive countless requests for meetings. They're polite to everyone, but the time they allocate and the candor they show correlates directly with their assessment of the visitor's knowledge and seriousness. Third, you need independent information to evaluate management's claims. If you meet management first, you'll hear their story but have no basis for judging its accuracy. Meeting management. Only after thorough scuttlebutt does Fisher contact management, and even here he's strategic about introductions. Ideally, someone management respects should make the introduction: a major customer, a significant shareholder, or the company's investment banker. During management meetings, Fisher draws on his scuttlebutt knowledge. He can ask specific questions about issues he's heard about. He can evaluate whether management's answers align with or contradict what others have told him. He can probe areas of concern and assess management's candor. Fisher notes that good managements are usually quite frank about weaknesses as well as strengths. However, they won't volunteer certain information. For example, a vice president won't say, "Our marketing VP is failing and will be replaced soon, but we have a talented junior person ready to step up." Fisher can only learn this kind of information through scuttlebutt before meeting management. Then observe whether management's responses are honest when he asks informed questions. The conversion ratio. Fisher reveals a striking statistic. Of companies where he actually visits management, he typically buys 1 out of every 2 to 2.5. This shocks people who assume the ratio should be far lower. The explanation. By the time Fisher visits management, extensive scuttlebutt has already screened out most unsuitable companies. He only visits when there's already substantial evidence the company qualifies. The visit is final confirmation, not initial exploration. If the ratio were based on companies considered for investigation, it would be about 1 purchase per 250 companies. If based on companies where investigation was started, perhaps 1 in 40. The high conversion ratio at the management visit stage simply reflects thorough preliminary work. Part 7. Conservative investors sleep well. In the mid-1970s, Fisher wrote a follow-up to address the devastated market conditions of that era. This section provides additional perspective on his investment philosophy. The 4 dimensions of conservative investment. Fisher organizes his framework around 4 dimensions. First dimension: operational excellence. The company must have superiority in production, marketing, research, and financial skills. Low-cost production. The company must be among the lowest-cost producers in its industry, with prospects of remaining so. This provides margin for survival in downturns and funds for growth in good times. Strong marketing. Understanding and responding to customer needs, explaining product advantages effectively, and controlling marketing costs. Outstanding research. Not just spending on R&D, but achieving results through effective coordination, team building, and market consciousness. Financial skill. Accurate cost analysis, early warning systems for problems, and efficient capital allocation. Second dimension: people factors. The company must have quality people and appropriate policies. Entrepreneurial leadership. A determined leader with drive and vision, but not a one-person show. Effective teamwork, delegation of authority, succession planning, and promotion from within. Continuous improvement culture. Constant re-examination of methods, willingness to take necessary risks, and adaptation to change. Employee relations. Treating employees with dignity, maintaining two-way communication, and creating genuine belief that the company is a good place to work. Growth discipline. Willingness to sacrifice immediate profits for long-term development. Third dimension: business characteristics. The nature of the business must create defendable advantages. Economies of scale. Size advantages that are real, not offset by bureaucratic inefficiencies. Market leadership. Being first often creates lasting advantages through brand recognition and customer relationships. Competitive barriers. Whether through technology, customer relationships, cost advantages, or other factors, the company must have characteristics making it difficult for competitors to displace it. Fourth dimension: price. The stock price must offer reasonable value. Price depends on 3 appraisals: of stocks in general, of the industry, and of the specific company. The critical question: is the current financial community appraisal more or less favorable than fundamentals warrant? For conservative investors, the best opportunities come when companies with strong first 3 dimensions are appraised less favorably than deserved. Market efficiency and its fallacy. Fisher directly challenges the efficient market hypothesis that became popular in academic finance. This theory claims markets instantly and accurately reflect all available information, making it impossible to identify undervalued or overvalued stocks without inside information. Fisher finds this absurd based on his own experience. He conducted experiments with Stanford Business School students, analyzing random samples of stocks over 5-year periods. The variation in performance was enormous. Some stocks rising several 100% while others fell 50% or more, despite the overall market rising moderately. If markets were truly efficient, such wide dispersions in performance wouldn't occur. The fact that they do occur, and that Fisher's methods have consistently identified outperformers in advance, demonstrates that markets are not perfectly efficient. The Raychem example. Fisher provides a detailed case study of Raychem Corporation in the mid-1970s to illustrate market inefficiency. Raychem had outstanding characteristics: strong research capabilities, proprietary products, excellent management. The company was spending heavily on a promising new product called Stylin. When Stylin failed commercially despite technical success, Raychem took a $9.3 million write-off. Earnings dropped from $7.95 to 8 cents per share. The financial community panicked. The stock crashed from over $42 to about $14, a decline of roughly two-thirds. This reaction ignored several important facts. Failed products are inevitable in research-intensive companies. They're part of the cost of success. Rachem's fundamental strengths, its research capability, market position, and management, remained intact. The failure actually freed up capital and research talent for other projects. The company was simultaneously reorganizing its management structure to handle larger scale more effectively. Fisher and his clients bought heavily at these depressed prices. Over the following years, as new products from freed-up research efforts reached market and the reorganization proved successful, the stock more than doubled from even the higher price of $23 where it traded after initial recovery. The lesson: markets regularly overshoot in both directions. Companies with strong fundamentals can trade at prices that are dramatically disconnected from intrinsic value, creating opportunities for investors who understand the business reality rather than following the crowd's emotional reactions. Part 8. Developing an Investment Philosophy. In the book's final section, Fisher reflects on how his philosophy developed over 5 decades. Early lessons. Fisher's investment interest began in childhood when his grandmother discussed stocks with a visiting uncle. Though the conversation covered only superficial matters, it sparked fascination that never left him. During business school at Stanford in the late 1920s, a course taught by Professor Boris Emmett proved transformative. The class visited Bay Area businesses, and Fisher offered to drive the professor. On return trips, Professor Emmett shared candid assessments of each company's strengths and weaknesses. One visit particularly impressed Fisher. Neighboring companies in San Jose, the John Bean Spray Pump Company and Anderson Barn Grover Manufacturing Company. Fisher told Professor Emmett these companies had probabilities of growing very much beyond their present size. Years later, after these companies merged with Sprague Cells Corporation to form Food Machinery Corporation, Fisher's assessment proved spectacularly correct. The Great Depression. Fisher graduated into the 1929 crash. Despite correctly predicting the coming bear market in August 1929, he failed to profit from this insight. He made poorly researched purchases in stocks that seemed cheap, which subsequently collapsed. This taught him crucial lessons. Correct market timing means nothing without action producing actual profits. A low price-earnings ratio by itself means nothing. It may indicate problems rather than opportunity. What matters is future earnings several years out, not current earnings or past price ranges. Analysis based purely on published data is never sufficient. You must understand the business through direct investigation. Food Machinery Corporation. In the Depression's depths, Fisher intensively studied food machinery. The company had outstanding characteristics: world leadership in its product lines, strong market position, excellent research developing promising new products, and management with both ability and integrity. Yet the stock traded at absurdly low prices because the public viewed it as just another speculative stock from the late 1920s bubble. Fisher made food machinery his flagship investment, buying every share he could for clients. This taught him about zigging when others zag, the importance of contrary investing. But Fisher emphasizes, being contrary is valuable only when you're also correct. You must have strong evidence that your contrarian view is right. World War II Interlude. During military service, Fisher had periods with little to do. He spent this time refining his investment philosophy. Key decisions. Focus exclusively on major, long-term capital appreciation rather than trading. Serve only a small number of large clients seeking growth. Identify a major post-war growth industry. He chose chemicals. Post-war success. After the war, Fisher spent months investigating chemical companies using his scuttlebutt method. He ultimately selected Dow Chemical, which proved spectacularly successful. During the late 1940s and early 1950s, Fisher again faced widespread pessimism. Most investors believed another depression was inevitable following World War II, just as depressions had followed previous wars. Year after year passed with no depression, but pessimism persisted. Fisher recognized this as another opportunity to zig while others zagged. The expected depression never came, and those who stayed invested in quality companies reaped enormous rewards. The 1950s and 1960s. These decades were Fisher's vintage years. Most holdings advanced dramatically, but he still made mistakes. The drug company mistake. Excited by a medical specialist's enthusiasm for a new drug, Fisher bought shares without his usual thorough investigation. The company and drug both disappointed. The lesson: never relax standards even when things are going well. The overvalued purchase. In 1969, caught up in the technology stock excitement, Fisher paid too much for an equipment company. Though the business performed well, the stock provided minimal return because the purchase price was unrealistic. The lesson: excitement is dangerous. Discipline about valuation matters. Straying from competence. Fisher made unsuccessful investments outside his area of expertise, in real estate operations and consumer products. The lesson: know your limits. Stay within your circle of competence. Holding through declines. Fisher addressed the controversial question: should you sell good stocks in anticipation of market declines? His answer: generally no. His reasoning: predicting short-term market movements is extremely difficult. Probably only 60% accuracy even with great skill. Predicting which stocks will outperform long-term is much easier. Perhaps 90% accuracy for skilled analysts. Therefore, don't abandon high-probability judgments, which stocks are outstanding, because of low-probability predictions, market timing. Even if a decline occurs, truly outstanding stocks will eventually far exceed their pre-decline peaks. Fisher illustrates with Texas Instruments and a fictional Central California Electronics. When both reached high prices in 1962, he warned clients the stocks were overvalued but recommended holding. Texas Instruments subsequently fell 80%. Central California Electronics fell 60%. Yet Texas Instruments eventually rose to many times its 1962 peak, vindicating those who held through the decline. Central California Electronics proved a mistake for different reasons. Management deteriorated. Fisher sold after recognizing this fundamental change. The 3-year rule. To avoid holding mistakes indefinitely, Fisher implemented his 3-year rule. If a stock hasn't performed after 3 years, sell it, assuming fundamentals haven't changed your view. This balances patience against accountability. 1 year is too short. Many good stocks lag temporarily. But 3 years should be enough for quality to emerge. Fisher violated this rule only once, with Rogers Corporation, where his exceptional confidence in management and his understanding of temporary difficulties led him to hold longer and even buy more. The company eventually rewarded this patience. Dividends reconsidered. Fisher's thinking on dividends evolved over time. He came to believe, for investors not needing income, companies with low or no dividends are usually preferable. These companies can reinvest earnings tax-free, compounding growth faster. However, institutional investors' influence has pressured even growth companies to pay modest dividends. What matters most is not dividend amount but consistency of policy. Investors need to know what to expect. Conclusion. The philosophy summarized. Fisher distills his investment philosophy into 8 essential points. 1. Buy disciplined growth companies. Invest in companies with plans for dramatic long-range profit growth and inherent qualities, making it difficult for newcomers to share that growth. These companies must score well on the 15 points discussed earlier. 2. Focus on out-of-favor situations. Buy when the financial community's appraisal is less favorable than fundamentals warrant, when stocks are out of favor due to general market conditions or misconceptions about the company's worth. 3. Hold for the long term. Hold until either A. Fundamental change in the company's nature, such as management deterioration, or B. Growth prospects are exhausted relative to the overall economy. Never sell based on economic or market forecasts. Almost never sell for short-term reasons. 4. De-emphasize dividends for growth investors. For those seeking major capital appreciation, dividends should be de-emphasized. The most attractive opportunities typically have low or no dividend payouts because these companies have productive uses for retained earnings. 5. Accept mistakes as a cost of doing business. Some mistakes are inevitable. They're a cost of investing for major gains, just as loan losses are inevitable for banks. The key is recognizing mistakes quickly, understanding their causes, and learning how to avoid repeating them. Taking small losses in some stocks while letting profits grow in promising ones indicates good judgment. Taking small profits in good investments while letting losses grow in bad ones indicates poor judgment. 6. Concentrate in your best ideas. Outstanding companies are rare. When you find them at attractive prices, concentrate your capital. For most investors, 10 to 12 stocks is optimal. More than 20 suggests lack of focus or knowledge. However, diversify across different industries with different economic characteristics to reduce risk. 7. Think independently. Success requires the moral courage to act contrary to the crowd when your judgment says you're right. But being contrary isn't enough. You must also be correct, which requires superior knowledge and analysis. 8. Combine hard work, intelligence, and honesty. Success in common stocks depends on hard work, intelligence, and honesty. While people differ in natural endowment of these traits, all can be developed through discipline and effort. Final thoughts. Fisher emphasizes that while good fortune plays some role, sustained success requires skill and consistent application of sound principles. Those who develop these skills through self-discipline will largely determine their own success. Looking back over his career, Fisher notes the striking parallels across decades. In each 10-year period, prevailing fears made most investors believe stocks were too risky. Yet each period created spectacular opportunities for those who looked past the fears to identify outstanding businesses. The 1930s had depression fears, the 1940s had war fears, the 1950s had fears of inevitable post-war depression, the 1970s had inflation and energy crisis fears. Yet in each period, investors who identified quality companies and held them through difficulties achieved remarkable returns. Fisher suggests that the 1980s and beyond would likely offer similar opportunities, and history has proven him right. The core principle. At the heart of Fisher's philosophy is a simple but powerful idea. Find companies with outstanding management, exceptional business characteristics, and strong growth prospects. Buy them when they're undervalued or reasonably valued. Hold them for years as their advantages compound. Avoid the fatal temptation to trade in and out based on market predictions or short-term price movements. This approach requires patience, discipline, and the courage to act independently of the crowd. But for those who master it, the rewards can be truly extraordinary. Fisher's own track record demonstrates the power of this approach. His purchase of food machinery in the 1930s, Dow Chemical in the 1940s, Motorola and Texas Instruments in the 1950s, each held for many years, produced gains of many thousand% for those with the patience to follow his methodology. The principles Fisher articulated over half a century ago remain as valid today as when he first wrote them. Markets still overreact. Exceptional companies still exist. Patient, disciplined investors who do the work to identify quality businesses still achieve outstanding results. Thank you for listening to this summary of Common Stocks and Uncommon Profits. May Fisher's wisdom guide you toward investment success through finding truly exceptional companies and having the patience and courage to profit from them over the long term.